I used to be a professor, together with Jorg, at Columbia University. And I was there for 15 years. And it was there as a professor and before where I did my PhD at Stanford, where I took factor investing as an academic discipline. In fact, there are 6 Nobel Prizes that have been awarded in the area of factor investing. I was also inspired during that time to apply what we learn in academia to the real world to make a difference. And I think that's the heart of ESMT today. And I was fortunate during that time to work with some very large investors, particularly European investors. And I've had, during my time as a professor, over a dozen years working with the largest fund in Europe, the Norwegian Sovereign Wealth Fund. I also worked with other sovereign wealth funds in Europe and in Canada and in Australia. And I learned during that time that it wasn't enough if you want to make a difference in people's portfolios to just live in an ivory tower. We definitely have to study these, but I would like to also make a difference in people's lives. And to do that, I realized that I had to come to industry. And in 2015, I received an offer from BlackRock. And I came to BlackRock primarily to put into practice everything about factor investing. And I believe that we need 3 things for factor investing to be as influential as the previous transformations of asset management. In the 1980s, this was a story about data and technology. And for the very first time, we had personal computers. And on that personal computer, we had mean variance optimization software. And that made tangible diversification benefits. We saw institutions move money from largely fixed income portfolios to beginning to invest in the growth opportunities in equities. We saw the rise of what we call today the endowment model, where we first started to invest in real estate and in other more illiquid asset classes. We could construct portfolios because of these advances in data and technology. In the 1990s, we saw the adoption of indexation. And today, rightly so, index market cap portfolios are the cornerstone of our portfolios. They can be done transparently and at low cost, providing benefits to millions of investors. This indexation is a remarkable story. I live in the United States. I've lived there for 25 plus years. And Americans, I think the last thing that they want to do is to be average. But indexation actually is all about being average. Now, I'm a pretty short individual, as you see up here. President Jorg, who gave me the introduction, he's quite tall. And I would pay anything to be of average height. In fact, I would be better off being average. And so market cap presents opportunities to empower our portfolios. And what happened to the adoption of market cap average was academics, the asset owners themselves, asset managers, and consultants, and regulators all played a very important role to transform the way that we invest. The 2000s until today has been a decade, 2 decades, about the rise of new investment vehicles like ETFs, the adoption of UCITS standards in Europe, and most recently, We see greater transparency and reporting of expenses through MiFID. All of that is about access through different investment vehicles, together with regulation to demand transparency and lower expenses. And it's these three that I realized these three things were necessary to take factor investing from academic theory to be as influential as those previous transformations. Data and technology, just as in the 1980s. We also need outreach, education, the spirit of cooperation between academia and business. And all of that I call a second pillar of strategic partnership and engagement, outreach in all of its various forms. And the third is investment vehicles, all the way from simple, easy to trade vehicles like ETFs to much more complex, more sophisticated vehicles more suitable for institutions. And I believe there is really only one place that could offer all of these three things. My life as an academic was over, and I came to BlackRock because BlackRock offers all of these three things. So I'm here today to talk about factors. And the very first study on factor investing was written by two professors at Columbia University, the institution that President Jörg and I were at for many years. And they were Professors Benjamin Graham and David Dodd, who wrote a book in 1934 called Security Analysis. And that book was the first systematic investment treatise. It was the beginning of the first factor study focusing on value. Factors are broad and persistent sources of returns. Broad means that we see these effects. We can buy cheap companies. We search for bargains across thousands of stocks, and we can do this across thousands of bonds. And we can even look at this outside in other asset classes, even in illiquid markets like private equity, or alternatives like commodities and foreign exchange. The second word, persistent, means that these premiums have been persistently rewarded for decades. 1934 was the first book on factor investing. So we have decades worth of data. We have scientific theories, including Nobel Prizes. One of my co-authors, Will Gertzman, and he's become a very good friend. He's a professor at Yale University. And last year, he published a paper in one of the most prestigious journals in finance, looking at momentum, another factor in 1800s Russia. That was actually a pretty big market in the 1800s, and it disappeared approximately 100 years ago. But we have decades and hundreds of years of data on these factors. So what I'm actually going to tell you today, it's actually not new. I think Graham and Dodd buying cheap or searching for bargains. The best investors have always wanted to go out and find and participate in trends. We have always, especially here, wanted to focus on the quality of investments because we know that not all earnings are the same. And we prefer earnings that are more stable and based on operations than one-off financial transactions. We search for smaller, more nimble opportunities. And we want to gravitate to safety, which we can do with minimum volatility strategies. All of this is actually not new. What is new? What is new is the way that we apply these factors to investments. Now, I run my life on my mobile phone. And to be honest, if I look at my mobile phone, there's relatively little that's new. Because 20, 30 years ago, we had cameras, we had maps, we had hotels, we had airlines. We even had phones. But the ability to put all of that onto a mobile phone, pretty much everything that already existed, has completely transformed our lives. Factor investing is that phone. By taking these concepts of buying cheap and finding trends, but now applying them across thousands of stocks, doing it transparently, pushing it to other asset classes like fixed income, applying it in portfolio construction, making it simple and accessible, has transformed our portfolio just as our phones have transformed our lives. So what I'm actually going to tell you is all about applications of the phone. Now, a very good question about factors is if we've known about these for decades, we've got Nobel Prizes, and we've studied this at Columbia University since the 1930s, why would these well-known intuitive patterns of buying cheap and finding trends and finding high-quality names, why should these persist? We have seen these factors for decades, if hundreds of years, and we expect these factors to result in higher premiums, making differences in our own portfolios because they are based on economic rationales. They are all based on a combination of a reward for bearing risk, structural impediments, or behavioral biases. Let me just tell you a little bit about some of them. And we'll start off with value, because Jörg and I, we were at the home of value investing. Now, a value company reminds me very much of all the Germans that I know. And they're industrious, they're hardworking, diligent. But sometimes they get beaten up. But in the long run, we know that those qualities really pay off. And look at Germany today. During a late economic cycle, like what we've been in over the past 1 to 2 years, value tends to underperform. You can think about a typical value company having factories or production lines. You can't manufacture something new or change your production lines overnight. And so these companies are relatively inflexible. So they tend to underperform when you most want that flexibility at the late economic cycle or in a recession. All of that fixed capital gives you economies of scale, efficiencies, or operating leverage, and they tend to do very well coming out from recoveries. Over the long run, we receive a value premium to compensate us for occasional cyclical losses. That's a reward for bearing risk. And because I'm an academic, or at least a former academic, let me just give you some jargon. What I've just outlined, intuitively in words, refers to a real investment conditional CAPM business cycle model with asymmetric and irreversible adjustment costs. And there are hundreds of papers that use those jargon terms and study this in finance. A second factor, minimum volatility. Most of its economic rationale comes from structural impediments. I live in the United States, where people don't save a lot, unlike Germany, and there are many public pension plans that are underfunded. They have severe restrictions on what they can do with their investments, but they have very high total return targets. The only way they can meet those high return targets is if they overweight high risk assets. and then they underweight low-risk ones, giving rise to high returns of low volatility strategies. This is a structural impediment that drives minimum volatility. And finally, we just have human behavior. As humans, we tend to over-extrapolate. We tend to overestimate probabilities of winning. We tend to pile into those types of investments that our friends or the media or others recommend. And those give rise to momentum strategies. These economic rationales are a scientific basis for forming our investments. And they have explained why these factors have existed for decades and gives us confidence that they will exist for decades to come. What would it take for value to disappear? Well, it will mean that suddenly all of those value companies would have to immediately transform all of their fixed capital, their factories and production lines, and turn them immediately to something else. And that's just not going to happen. What would it take for minimum volatility to disappear? Well, it would take all of those underfunded pension plans. It would require injections of massive amounts of money and freedom on their investment policies. And I don't think that is going to happen anytime soon. And only if we change human behavior will we stop following trends of overestimate probabilities of winning. These factors are going to be with us for a very long time. Now, I'm going to talk about some of these topics here. We won't cover all of them, but I want to cover capacity because this is an exciting growth area, and so a valid question, even though these have been based on scientific theory, is how much capacity is there in the market? I would also like to spend a little bit of time on time-varying factors. We've witnessed this because we just said that during a late economic cycle, like where we are today, value tends to underperform. And then finally, I'd like to talk about ESG, environmental, social, and governance aspects. And these dovetail very nicely with factor investing strategies. So let's turn to this question of capacity. This presentation is freely available, and there's a few scientific papers that are dotted throughout, and all of these can, of course, be referenced by you at some stage. Now, the capacity question is an important one because factors have been growing at a very fast pace. These are numbers for the United States. The growth rates for Europe have been even faster. Today, in the United States, we have approximately $500 to $600 billion invested in factors, delivered through ETFs. And you can see that these growth rates, 500 million today, compared to about 350 billion last year. Can this continue? What is that saturation point? What's the capacity for these factors in our portfolios? And I want to get at that in a couple of ways. So the first thing that I would like to do is take the perspective of what I can do as an individual. I can go buy a factor fund. And then I'll take the perspective of what others are doing in the market, particularly active managers. And I'm going to rely, just because we have a large data set, very long and very extensive in the United States, of active mutual funds. And then finally, I'd like to, because this is an academic institution, give you a little bit more of an academic perspective based on some calculations from an equilibrium model. Actually, it's a no arbitrage affine model, to be exact. So let's turn to the first one. What I can do as an individual is I can go buy a factor fund, like buy a factor ETF. And if I do that, that money has to be put to work, and ultimately that investment or fund is going to have to purchase some securities, preferably those that are cheap, that are trending with high quality names, those that are smaller and more nimble securities and with more stable returns. Those are all characteristics of factors. Now, if I buy a security, I incur transaction cost. And these are actually transaction cost curves. They slope upwards because the more that you buy, the more that you pay in transactions costs. This actually is the transaction cost that's faced by our firm on June 26 in June 14th, 2016 for buying Apple. Now, we can use these transactions costs to answer this capacity question. Because the more money that goes into a fund, the more your transactions costs. So this suggests that one estimate of capacity is we're going to find the amount of money that can go into these factor funds such that the market frictions associated with those new inflows, they increase to a point that they cancel out the historical high returns that we've observed in factor strategies. This is actually an implicit equation that we're solving, and we're going to solve this for every single stock with the associated transaction cost curves, and we're going to add up all the new inflows such that the transactions costs are going to wipe out the historical factor premiums. Those numbers are very, very high. The associated numbers with these are around trillions of dollars. And we just saw the numbers that were invested in this today, which is about 500 billion in the United States. So we are very far from saturation. Multi-factor combinations, in fact, have capacity well into single-digit trillions of dollars. Now, we can actually see some of that if we look at where we are with factors relative to the whole market. This is the S&P 500. It's around $27, $28 trillion. And that very small circle down the bottom, that yellow one, is where we are in factors. To put this into context, if you take market cap index or active funds in the United States, they are orders of magnitude larger. Those are the two larger circles, the blue one and the pink one. So we have substantial ways to go before we hit capacity. Now, that's what I could do as an individual, is I could go buy a factor fund. But another way to view capacity is what others are already doing. Well, there aren't that many people still invested in these factor funds. But I can go a little bit further, and I can take all of the holdings of active funds in the United States. These are classified as active mutual funds that are tracked by Morningstar. And we're going to take holdings level data, and we're going to split up the active returns of these funds. That's the return of the fund minus the stated benchmark in their prospectuses. And we're going to estimate three components. The first one is static factor exposures. For example, a value manager, almost by definition, should be exposed to the value factor. The second component is we can look at time-varying factors, in fact, time-varying components of different types. And then the third one is true security selection ability. Now, a thought experiment is I could take that first component of static factors and change them from relatively expensive and more opaque traditional mutual funds to relatively cheap, completely transparent, and easy to trade ETFs. And if I do that, I actually haven't changed anything because the factors are already being done. But I have, I think, made significant progress in investor welfare for our clients. That first component is around $2.5 trillion. out of approximately $3.5 trillion of active funds in the US, substantially more than the current amounts being invested today. There is one factor that's shown here which is very interesting. And it turns out that active managers don't really hold stable stocks. Well, why? Well, if I have a benchmark to beat, the way that I beat that benchmark is by taking on risk. So I'm actually long risk. Well, if I'm long risk, that means I have negative exposure to low risk. And that's what this graph is showing here. So another estimate of capacity is I could measure what it would take to move from that negative exposure for low volatility back up to neutral. All right, and that's an estimate of capacity. And that represents a movement of around $700 billion. Now, the final estimate for capacity, we're going to appeal to an economic model. I've got some statistics which look at market capitalization of value stocks, those that are cheap, versus expensive stocks. And the value stocks are down on the bottom, and they're around 10–15%. And the expensive stock market capitalization is on the top, and you can see that that's substantially more, around 50–60%. Put simply, there's not enough money in cheap stocks. But cheap stocks have long-run returns. So we're going to estimate an economic model. Technically, this is called a pricing kernel. And the way that these pricing kernels work is as follows. It's very similar to a seesaw. So what we're actually going to do is we're going to see that value stocks, we said that there's not enough money or capital devoted to those, but they have high returns. The pricing kernel is going to operate as follows. When more money comes in to those funds, to the cheap value factor funds, those prices are going to increase. And as the prices increase, we can think of prices coming up, but the returns of these stocks, the payoffs remaining constant. So as more money comes in, prices increase, the cash flows for these stocks remain the same, and we've shrunk the difference between the price and the payoff of these securities. More money coming in means prices go up and expected returns go down. But if I buy something like the cheap stocks, I have to sell something else. So let's sell the expensive stocks. The expensive stocks have low returns. That means that there's not much of a difference between the price of that expensive stock and the payoffs or the cash flows of those expensive stocks. As I start selling, money comes out and those prices go down. And they go down such that the difference between the price and the payoff increases. So as money goes out, prices go down and expected returns go up. And actually, this calculation is made formal. Technically, we're going to assume a linear pricing kernel and then estimate the amount of capital transfer such that those factor premiums would go away. It is substantial, the amount of capital that is required. So we're going to do some thought experiments in the Farmer and French data set, which goes back to 1925. The value premium is approximately 4% per year. Right, that's huge. That's a huge number, particularly in today's environment of very low rates. And we said that there's not enough capital in the value. That's that 15% number up there. Imagine if we transferred all of the capital from the expensive stocks, right? That's the growth ones. And we're going to transfer all of that to value. Well, according to our C-store, the value premium is going to shrink. And it shrinks from 4% to about 2%. So it's still there. 2% over many decades is a very meaningful figure. There are some factors like momentum which barely budge. And we look at the momentum premium, it's even higher than the value premium. So that number is around 8%. And if we transferred all of the money from those stocks with negative momentum to those stocks with positive momentum, well, the momentum premium will shrink, but it barely budges from 8% down to around 6 to 7. So by all of these calculations, what I could do by myself via transactions costs, what others are doing, the different clienteles in the market, and then finally, economic equilibrium models, capacity in this rapidly growing market. Yes, it is rapidly growing for all reasons that we know about. The capacity of factor investing is enormous. Now let's talk about time-varying factors, because what we've done here are long-run equilibrium computations. In the long run, there is massive capacity. In the short run, well, these factors vary over time. So let's look at how we might take advantage of that time-varying factors. We just said that over the past couple of quarters, value hasn't performed so well. And on accumulated return graphs, that's the bottom green for the United States on the left and for the world portfolio on the right. There are some factors that have done very well. So the orange line that's been quite steady in 2019, well, that's a quality factor. Actually, you might expect that if we're in a very late economic cycle where we actually see some evidence of slowdowns in Europe and in Asia, then probably you'd prefer to hold stocks that have lower leverage, that have more stable earnings, and those stocks that have higher productivity as measured by ROE. And indeed, that is the case. Quality has outperformed during these uncertain times. So how might we take advantage of these time-varying factors? In some papers that we've published, we've developed a model. And I'll just talk about some of those signals that we use. We look at valuations and relative strength. All assets, including factors, become rich or cheap, and they have trends up or down. And we can take advantage of these trends or valuation and factors just as we would in other investments. We talked a little bit about the economic cycle. And we said that during recessions or at the late economic cycle, value tends to underperform. And we've actually witnessed that in 2019. But during that time, other factors, the more defensive factors, tend to outperform. In 2019, quality did very well. Minimum volatility over the business cycle should also tend to outperform during the late stage or during recessions. This is a time that we should be wanting to take risk off rather than putting risk on. After we've had that slowdown, then we enter a recovery. Smaller stocks have large exposure to an economy that is improving. And we also said that value stocks have large economic efficiencies, and that makes value tend to perform coming out in the recovery periods. The economy then settles down into trends, and the trend factor momentums does very well in the latter stage of a business cycle. And then finally, we get to peak, and that's the time that we should move back into minimum volatility and quality. Well, where are we today? How are we positioned with these factors? Today, we are overweight quality. We have underweight positions, as you can see in the last column, in momentum. And a large part of that is where we are today in the business cycle. In that first column, we are at this late stage economic cycle, which means that we prefer the more defensive factors of quality and minimum volatility. But we don't look only at the business cycle. We also take into account some of these other indicators. So some factors are very cheap. value did not do so well in 2019. So the price of value has decreased to a point that, yes, actually, there is value of value. And then finally, we look at how well those factors have done recently in the relative strength. And that gives us our final under and overweights to these factors in the last column. Today, we are long quality in the United States, in Europe, and in our global models. All right, let's talk now in our last 10 minutes about ESG and factors. Okay. I want to recall why these factors exist, why we've had them for decades, why we've had thousands, tens of thousands of academic papers. They're all based on an economic rationale. There are 4 criteria behind the factors, and the most important is the economic scientific basis, the reward for bearing risk, the structural impediment, and behavioral bias. But that's the realm of academia. To make a difference in people's portfolios, we would also want to have large evidence, empirical evidence, to back up that academic theory. We also would like differentiated returns, particularly with respect to plain vanilla market capitalization, equity, and fixed income benchmarks. And finally, we want to pass on these costs and the advantages of transparency to all investors. Certain, but not all, ESG will satisfy this criteria. An obvious one that doesn't is renewable green power, which almost by definition is not that scalable, and it's not very cheap. So is ESG a factor? It does not satisfy all 4 of these criteria. But that does not mean that we cannot embed ESG into the factors themselves. So not all ESG criteria will satisfy these, and not all ESG criteria in particular will stem from an economic rationale. But some ESG data and signals do. For example, if we look at the E for environmental, then whether a climate treaty is adopted or a carbon tax is adopted, that is a form of market structure. And to the extent that it falls under that structural impediment, perhaps some of E signals may be useful in forming factor portfolios. We talk about investor behavioral bias, but there are other behavioral biases as well from employees or managers and even regulators, or for all market participants, all participants in the economy. And to the extent that certain S or social variables will play into that, then some of those may be useful in forming the factor definitions. And then finally, we have the reward for bearing risk. Some Gs for governance actually will reduce risk. If we can lessen agency frictions, if we can align incentives, if we can make managers divest less and put those funds to other stakeholders for the company, well, we're actually going to reduce risk. And to the extent that certain G variables will play that role, then perhaps we can incorporate them into the definition of factors. It turns out that the factors are already ESG friendly. These are correlations of factors with ESG scores. Minimum volatility and quality in particular already have significantly better ESG scores than the market portfolio, than the average company. There is one factor that does not, and that is size. And most of that is driven by the biases in the ESG data. Because generally speaking, you have to be a pretty big company to report any of these ESG scores. And if you don't report, which happens to be much more of the smaller companies, then by definition, because you're not reporting that ESG data, you tend to have a lower score. I believe that will probably change over the next couple of years. But because there are factors that have significantly better ESG profiles than the market, it turns out that a multi-factor combination of all of these factors here, value, quality, momentum, size, and minimum volatility, tends to have significantly better ESG scores and also lower carbon emissions than the market portfolio. So if you're a factor investor and you buy cheap, you find high quality names, and you would like lower volatility returns, you are already an ESG friendly investor. But we can actually go further. And I want to talk now about how we can embed some of those ESG data into the factor definitions. We're doing this in live money today at BlackRock. These are already incorporated into our factor definitions. And the first one that I want to talk about is green intangible value. Now, intangible capital is becoming more and more important for companies. In fact, I think you'd be hard-pressed to find a leading company where all of its assets were in brick and mortar or on fixed physical capital of machinery. A lot of the capital of a company today is intangible. Patents are a very interesting data set because patents represent the monetization of intellectual capital. Put simply, this is all about the mind, rather than surely things about brawn or fixed capital machines. So the patents actually are useful in of themselves to make a stab at intangible value for a company. This chart shows a more traditional measure coming from a balance sheet and earnings income statement, which is research and development expenses. Now, research and development is a pretty good thing for a company. You want a company to invest in R&D and therefore lead to more profitable opportunities. The patent data set, well, patents usually aren't captured in the traditional earnings income statement or the balance sheet. But there is a relationship, and you can see that R&D spending tends to go up before the award of the patent, which is classified here as event time 0. Indeed, some patents are the result of dedicated R&D spending. What's also interesting is that R&D continues to go up after that patent is rewarded, perhaps as a result of a company trying to monetize or commercialize that intellectual property. So I just want to state here that patents are an alternative data set, and they are linked and complementary to the traditional income and balance sheet variables that we tended to use in forming these factor signals. Going further, patents are filed in different classifications. There's fields. These are harmonized worldwide by the World Intellectual Property Organization. The most influential patents will be filed in a certain field and actually have influence way beyond, in some fields, totally unrelated to that patent. One of them that touches your lives every day is Google's PageRank algorithm. That was a patent. And now that algorithm, that patent, is cited in fields completely different to computer search in sociology and economics. It's highly influential. Some patents are filed under classifications that correspond to UN Sustainable Development Goals. Those are called green patents. There are green patents, brown patents, white patents, and other types of patents. Those green patents have incremental predictability above and beyond just using patents as a measure of intangible value. The intuition behind this is that there are many ways of generating profitable opportunities for a firm. But the UN Sustainable Development Goals, these are challenges for society, but they also represent great commercial opportunities. Because if you can solve the problem of delivering clean water, of delivering green energy, well, not only are you going to contribute to problems for society, but you have the opportunity to also make a lot of money. And so it's not surprising that if we can look at green patents, and what we're doing here is counting the number of green patents awarded to different companies controlling for sector and country and a few other transformations, but those companies that invest more in these UN Sustainable Development Goals, as represented by intangible value through patents, they tend also to generate returns, high returns. So this is a measure of value, but it also happens to be ESG. Another example is culture. And I have to admit that when I was a business school professor, I was in finance, and I spent a lot of time concentrating on my field of economics and finance, and probably not so much in marketing, wherein my real job at a company today is extremely important. I spent less time as an academic on accounting, which at a real world company is extremely important. And I also spent less time on organizational behavioral leadership, which in a real world company is also extremely important. Partly, these are all lost opportunities that I should have taken far more advantage of when I was a professor. But one of the reasons why is that corporate culture is undeniably important, but it tends to be more qualitative. And anything that is more qualitative, well, it's harder to study because you don't have quantitative information behind that you can do rigorous analysis. A breakthrough is a paper written by 3 professors, one of them in Europe, the first one, and then the last author, Luigi Zingales, is a friend, and he's at Chicago. This paper quantifies a usually more qualitative element. It quantifies corporate culture. And it does so by looking at 5 pillars. The pillars are listed here: innovation, integrity, quality, respect, and teamwork. And what we've done is follow some principles outlined in this paper. Of course, we adapt and we have our own proprietary algorithms and code. But we're going to go through 10,000 broker reports that our firm receives every year. These are text information. And we use machine learning techniques to process all of that text to come up with words that are similar to and fall into these 5 pillars. The way the algorithm works is a word like integrity, you have a seed list. And so integrity would be associated with transparency or accountability. And there would be a couple of other words that you'd start off and seed that algorithm. The algorithm actually learns. These are called deep learning algorithms. The algorithm learns words that are adjacent to and puts more words in as it reads through all these documents, coming up with a dictionary. And then we can count, adjusting for the word composition and the word frequency and length of each of those broker reports. And we can count all the words in those dictionaries to come up with a quantitative measure of culture. And when we do that, well, is this ESG? Absolutely, it's ESG. These are evidence of things that are social and they're related to governance. They are also a form of quality, non-financial quality. And we can add non-financial quality to the traditional financial quality, things like what we talked about earlier, variability of earnings, leverage ratios. We might look at cash flow components of those earnings. We could also look at ROE. We can add this corporate culture to the more traditional financial quality, coming up with a new signal that embeds ESG. This is a recent paper that we've just released. It's called ESG and Factors. It's not on this list here, but please ask ESMT. It's also available online, so we're very happy to pass on this paper to you. So factors are broad and persistent sources of returns. They've existed for decades. They have impeccable academic qualifications. What's new is applying these to our portfolios. There's ample capacity. The growth rates are fast because these have scientific backing, transparency, and we can deliver these at low costs. They play a really important role in the way that people can save. And finally, ESG and factors, well, they can dovetail and go together. And ESG opens up many more opportunities for factor investing, but we are committed to these intuitive, economically based styles of investing. Thank you very much.
Yeah, thank you very much, Andrew, for a very fascinating, inspiring discussion. We have a couple of minutes for questions and answers, and in particular, I would take maybe the last comments you gave. So first of all, there is a very positive view on, you could say, the democracy of capital markets when it comes to what you do and how you offer it. And the second one, and that might be even a stronger statement at this point of time, it seems to be that factor investing, or you could say capitalism, can be able to heal itself when it comes to ESG based on, say, biases or other factors. Could it even be that with the strong movement we now see on the streets and everywhere, so say the biases towards the E becoming even stronger, these effects also to become stronger, maybe even combined also with the patterns that you described?
I would say that you are much more qualified to have an opinion on that than me. But I will say that the purpose or vision that we have for factors is to democratize access to broad and persistent sources of returns. And that's our mission statement. And all these factors, they used to be only available to the most elite, usually very large and sophisticated institutions, even as little ago as 10, 15 years. But what's happened is we can take all of these concepts of buying cheap and finding trends. They don't have to be for the large, sophisticated institutions. They're really for everybody.
Right. And this is probably, as I said in my opening remarks, that's probably something that in particular in this country has huge value, seeing these high savings rate combined with below average financial wealth and therefore means. The E part, the patterns is also obviously a very interesting insight. So would you see on this side a trend that you can observe already from the fact that how much emphasis has been given on E also in public discussions?
Well, I really like, I think, to take a broader view where I think this is just the next manifestation of taking on factors. At the very first, we talked about Graham and Dodd from our right. old legacy, and at that time, accounting standards accounting data was not standardized. Even looking at book value was a very new thing for Graham and Dodd, and then we had standardization a couple of decades later. So everything there was actually new. Even just looking at financial statements to assess a company rather than just walking through and shaking a manager's hand. Right? This was completely new in the 1930s. And then we also had during the 70s and the 1980s, the first ability to take on big data. We had initially tapes, literally tapes that we had on mainframe computers, and factor investing led the way. And then we had large data sets that you actually couldn't fit onto a single floppy disk. And it was state of the art to actually push factors into what was at that time innovative and big data sets. And today, well, we've just seen it, that I think we're going to go beyond now, and we're going to talk about integrating all of this ESG, well, certain ESG metrics that will always come into these factor definitions. So I completely agree with you that this is such an exciting field. I just view it now as the next stage where factors have always been at the forefront.
I've maybe one related question to what you just said regarding balance sheets. So when we talk to CFOs today, many of them tell us that, well, they prepare their financial statements and now exaggerate, obviously, the investors don't care. So they don't care about the numbers per se, but rather they care much more about what is the outlook. Given that we are in a disruptive world, it doesn't matter too much how you have done and what is in there, but rather how you can take the next step in development. When you take this from your perspective,
central banks too.
Yeah, right. So right. I mean, so when you take this from your perspective, how do you take this into account? Maybe big data or other aspects, or culture, or other some of these aspects.
Yeah, it's very interesting because I said that we were looking at textual analysis in the very last thing that we talked about to quantify culture. And there's lots of text that's produced by companies, including text that is submitted to a regulator. So you'd have a filing in the United States to the SEC. And it turns out that the information content in those regulatory filings worldwide is lower than the textual information that's produced by broker-dealers or by the financial press.
Okay, maybe then one more question, and then obviously we are also happy to take a question on the floor, but maybe one more from my side. Now, you said, which is also very impressive, that the capacity for doing more of factor investing is actually pretty significant. At the same time, we see when you include the passive investors, the pure index funds, you also see now a discussion on what it means for corporate governance, moreover. So this means how much of interference is there really from investors with what is happening within the company. Now, one obviously could say that the governance could also come from the factor side in a more indirect way in valuing things that also societally or in other ways is good. What do you make out of this discussion of corporate governance in light of an increasing share of of passive investors?
Yeah, this is a great question, and I'm going to give here personal remarks. And I think the difference here between a purely or traditional index or passive with a traditional active approach, actually they're all becoming blurred. And the active managers, they have, I would say, tended to more exercise certain corporate rights than the passive ones. But we see some shift in there, and then the ability of access in vehicles plus trading costs have caused some structural outflows from those traditional clienteles. At the same time, the index managers or the passive managers have enjoyed just tremendous efficiencies and passing on low costs and transparency to investors. They have not traditionally exercised corporate rights associated with their votes, and so I think it's a little bit. It's very interesting that these things are blurring, where the index or the passive managers have to become more active. The active managers, well, they have to recognize that that landscape has changed, and the access to investments, the ultimate transparency and the low costs, well, those are as important now today as what their traditional active investment activities have been. And I think probably in a few years' time, we'll just see almost a complete merging of these effects.
Which again is looking at the sheer size of the volumes, which would be a great, I mean, let's say not great, but a grand revolution of financial.
Oh, I think the whole area we've gone off into an incredible journey that just increases. All of this just simply increases investor welfare.
Thank you. So, are there questions from the audience? Yeah, please. Sure. We have also a microphone in a second.
Hi, Ivan, an alum of this business school. The underperformance of value has certainly made investors skeptical. And in an article, September 2018, you mentioned that value is an underdog. And it will make a comeback when you least expect it. Now the question is 16 months later or 14 months later, do you still see value as an underdog? And when do you see it making a comeback?
I am a value investor. And precisely because value sometimes fails, we are rewarded with a long-term value premium. If we look at the worst episodes for value, and we have data academically, thanks to Farmer and French, so Eugene Farmer and his longtime co-author Kenneth French, that starts in the 1920s. In almost 100 years of data, this value drawdown is the 6th worst one. So that's pretty amazing. So it's not unprecedented, but it's certainly severe. The worst one is actually during the late 1990s. And then we also have other bad periods during the 1930s. We had some bad episodes in the 50s and 80s, but they're all characterized by being either at the bottom of a recession or late economic cycle, which we are today. One of the differences of today is we are approaching, not yet, but we are approaching one of the longest durations of that drawdown. So there's both a magnitude and then how long it lasts. We're not at the longest one yet, but it's certainly been prolonged. And I think one of the differences for today is we are late cycle today, but we were also late cycle a year ago, if not longer. And I think you can argue for various aspects of why this business cycle has been so prolonged. Right? Perhaps a large central bank located in a German city plays some role in that, as with other policy authorities worldwide. And then we also have some fiscal policy effects, particularly from the United States. But that, I think, is what's unusual about today. Economically, we should expect value to underperform during a late economic cycle or coming in to the bottom of a recession. Why it's been just so prolonged, I think, is an interesting academic topic.
I saw one more question. Oh, yeah, please.
Hi, my name is Anna. I'm thinking more about the perspective that society is on when you talk about BlackRock. What was missing to me today was a little bit perspective why BlackRock is having a big influence on politics, especially they are planning to have Friedrich Merz here as a chancellor. And even Macron is kind of having that kind of influence by Larry Fink. And why is that? And how we are gonna be influenced by that in perspective?
I'll just say that I think all companies, including BlackRock, we as modern corporations have to have a purpose. And our purpose includes being involved in all aspects of society. And that's been made very evident in our most recent CEO's letter. And we would like to engage at every single level. And I don't think that that's not only true for BlackRock, but I think for any modern corporation that seeks to have a real purpose and ability to progress society in the world. That we're in that company.
I saw one more. Yeah, please. We have one more question.
Thanks. My name is Tiziano. Just an easy question. You told us that actually the factor investing is basically at the early stage. There's more room to grow. What do you think? Which dimension can reach the factor investing in the next 5 years in terms of business? A couple of trillions more? Thanks.
Well, I certainly hope it will be a couple of trillion, but I actually want it far more reaching than that. I want factors to be so prevalent that when you sit down with a financial advisor, or it could also be with a machine, with a robo-advisor, and you decide on your life's goals, and you'd say, I'm really worried about losing my job. You're making a statement about a factor because you want to protect your capital, and there are factors like quality and minimum volatility that help you do that. Or you sit down and you say, I really would like to save for my children's education. And that means you want return-enhancing factors, and there are factors that will help you to do that, like momentum and value. And I want factors to be as a way to implement your goals. And with developing software, relationships, and all of the education required to do just that. The flows in financial products associated with factors, with all the advantages of low cost and transparency, yes, they will benefit too. But my measure of success is a complete sea change in the way that we view savings altogether.
So maybe the last question, please.
Thank you for the great presentation. My name is Ingolf Pernice. I'm from Weizmann Institute. I understood that the great strength of smart beta and all these investment strategies is that it's automized and so accessible to all. Imagining that this would become very big, is there a way for companies to sort of game this idea so that they modify or they optimize their balance sheets in a way that your algorithm catches them for investment, or more specific for these ESG factors, that they just spur more news about like ecological advances and stuff like that?
Yeah, this I would say you can mitigate, but the real defense is in taking cheap stocks across a universe of thousands and not relying just on one company. We can also mitigate this effect by using more than one measure. So if you only rely on measuring cheapness by one particular financial variable, well, that financial variable could be gamed. But if you use several, especially those that are tangible, like cash flows, for example, then that is less of a concern. And if you go further to some of the variables that we talked about at the end, which include other alternative measures, then I think that management by a company, that becomes even harder. So the defenses are that you diversify as wide as possible in your portfolio, and you also diversify in the signal set to construct that factor.
So now let's have a very last question, please. Yeah.
A couple of years ago, I had the pleasure to listen to your presentation when you released your book. And one of the messages was that investors shouldn't sin too much in terms of factor timing, just rebalance. Now you presented a whole metric according to which you time the factor in an economic cycle. So have you changed your mind with respect to factor timing or the possibility of factor timing?
We've always believed, with actually a large body of academic theory, that these factors vary over time. The approach, though, and the question for what investor ought to do, I think, is a very investor-specific one. Just as the amount of equities that you should hold in your portfolio is a very specific question for an individual. So for many investors, I don't think you might want to time at all. The best thing is to hold a diversified portfolio, put in stocks and bonds, maybe some other asset classes. Within equities, within fixed income, let's take on these factor premiums and then simply rebalance. Rebalancing actually is a form of timing because you sell the things that have gone up and you buy the things that have become cheaper. And for most investors, that form of timing, that's sufficient. For certain investors with the right risk tolerance, perhaps with the right governance structure for an institution, then there is a possibility of generating incremental returns. But again, the appropriateness of that would be a very specific investor question. I do believe that it is possible to add value modestly and with humility by harvesting time-varying factor premium.
Good. Thank you very much. Thank you very much, first of all, for your active contribution. Yeah, and obviously I wanted to add, thank you very much, Andrew, for all your thoughts, your insights, also for being so open for all the questions. Thank you very much. And before we can give a final applause to Andrew, there is the option to continue these discussions. There will be snacks served here just on the floor. Thank you.
Thank you.
Good morning.